All right, I'm doing a little follow up on the recording today. Going through the balance right here, you can see 260 on the put side, 250 on the call side, and then as you go up a number, it goes 315 on call side, 119 on put side, and then if you go down one, it goes 264 to 136, right? Um, and so you can see as you go further down, you're having to pay out more puts. As you go further up, you're having to pay out more calls. So what does that mean that is happening? No, no, I'm not a big deal. So what's happening right now with inventory? So, so what's happening is as we go down, what are people that are sitting at 660? So let's say they bought a zero DTE at 660. So if we look at this 660 again, the picture that I posted has $320,000. I mean 320,000 calls at 660. What are they doing? They're getting unhappy and starting to take what? You sound like you said profits. They don't have profits. They're underwater, right? It's going against them. No, no, no. So the 660 calls, right? So what's happening is the market makers, those 660 calls at this particular point in time when I pasted this picture were 17-cent delta, and now they are, what are we? A couple dollars lower. I can't read that. So as we pull away from it, right? As we pull away from 660, the the balanced position for the hedging of that call that they sold, they can now start to unwind. Does that make sense when I say that? Is everybody clear about that? The market makers. The market makers. So the market makers, the question was who's they? So the market makers are balanced at neutral at this, 668 point. And so, like, all right, price is moving against the call position, meaning we're going down. And so they have to unwind that call position of hedging, as well as people are just giving up and selling it. And they're closing them out because they're not going to be worth anything. And so then they can completely get rid of that. But at the same time, what is happening to the people that were, so we were at 668. I'm sorry, 658. So there we go. I got the numbers to pull up. So looking at it right now, this you guys see the 657 and the 656s. How many hundreds of thousands do we have now? There's 350 at 667 and 350 or 330 at 656. As price gets to those levels, what do the market makers have to do now? It's the opposite of what they were doing on the call side. So if they're selling their shares to balance out the delta on the call side, what are they doing on the put side? No, you're on the right track, Marlon. You're just flipped. They're not buying. They actually have to short to manage the right because they buy on the call side, so they short on the put side. So what ends up happening is, and this is what causes their movement to the next zone, is you've got a double whammy happening here. You've got the people unwinding their call positions, selling them, the people unhedging those positions, and then as price moves downward, then that's where it's like, okay, now I actually have to start shorting more to hedge against these positions. And so you've got the selling and the shorting going on, which is just like when if it's going to the long side, what would you have happening? Well, you'd have more buying and short covering, right? So it's the exact opposite, and you're going down. Now, what's going to happen is you're going to get to an extreme here, and that's why I said, what's the extreme? At what level are we going to get to where the market makers are going to say, you know what? No, I'm not going to pay for the 655 where there's 327,000 that I got to pay out at the end of the day versus 39,000 calls. And then they're going to start holding that line. Does that make sense? Where is that level? I think it's 665. I think 665, I'm sorry, 655 is that level. Now, does that mean they're going to have the ability to hold that level? No, that's what a long squeeze and a short squeeze is. Sometimes they can't hold that level, and they got to pay out the yin yang because the selling was so heavy or the buying was so strong that it just goes flying through these levels. But I believe if you're a market maker and you're sitting on the September 25th, you know, puts at 655, 654, it's like, yeah, let's start hedging against that position to try to hold the line here because we don't want to pay out all of those people. Does that all make sense? So like right now, if you thought it was a bounce opportunity area, it's like, all right, well, let's buy a call. And the call that I would buy would be 654. I would buy the 654s here and I would say, all right, if it drops another dollar down to 654, I'll add. But if it starts getting lower than that, I'm just going to get out the way because there's just nothing underneath us, too much selling pressure, and the Bears are in charge today, right? Does this all make sense? Because what's going to happen here as we get extended is you're going to have people like me that are willing to buy this extension. And you're going to be like, all right, we've moved pretty far, pretty fast. We're getting to a range. We're getting to the next zone. We're getting to an area that's going to bounce, and we're going to create a buying somewhere in this little in this box here. And if we can't get a bounce, we're just going to give up. And then you're going to get this huge candle panic wash where everybody's stopping out and you're just giving up and you're like, all right, hit 650. That's the next level. Just go for it. I don't think we're going to do that. Yeah. So the image I posted earlier is right here. It's just the options chain right there. So yeah. Think about it like this, Eric. If max pain today is 661, who's in pain if we're closing at 650? Well, the bulls are for sure, but so are the market makers. They're the ones that sold all the contracts. They got to pay all this stuff out. They don't want to pay that stuff out. Heck no. Right? And so what they're going to have to do at that point is not only are they going to have to adjust their inventory from today, but they're going to have to start adjusting them for tomorrow and the next day and the next day. But if you can, and this is why the slow grinds are the worst. Slow grinds are the worst because they can just go on forever because inventory is relatively balanced. Maybe it's down a little, up a little, down a little bit. But when you get these humongous drops, inventory is way off, right? And so you got to buy, you got to hedge, you got to do all these things that creates volatility. All right, I'm going to take off some low side here of this. So, so if you have the ability to do so, pull up the 654, look at the 1 minute chart, and look at the flow. I mean, you buy it at 140, it's at 175 now. You take 35 cents out right here. This allows you to drop this thing to $1 and still be green by 5 cents. So what needs to happen now, right? Like again, it's not magic that I can pick these levels and it always bounces. Well, not always, but pretty high percentage that it bounces. So it's this is the auction process that's literally done over and over on every single time frame, on every single stock, every single day, all the time. It's just candles are a drawing of human behavior, and what the behavior that is happening now is the all the bulls are getting pissed, all the shorts are getting happy. What that means is the bulls are unwinding their position. The market makers are hedging against the puts that they sold while they unwind their calls. But it gets to a point that's so extreme that the payout becomes very, very imbalanced. And for it to go lower, you have to have a massive squeeze. And what that means is you've got to make it so overwhelmingly bullish and or bearish that the market makers are not going to be able to play a multi-day hold. So for example, going into tomorrow, if they can hold it here, do you think they care about these 656 or 655 puts anymore? No, they've expired. So it will be much easier to bring the price down tomorrow than it will today. So going from 655 to 650 today is much harder to do than it will be tomorrow because these options have expired. Does that make sense? Are you guys able to grasp that? And again, when you read market and profile and you read who are you playing against, day traders, swing traders, long-term traders, like this is always what I'm talking about. Who are you playing against? Right? So right now, we're playing against the people that don't want this thing, or we're playing with the people that don't want this thing to close under 655. Because at that point, you've got 350,000, definitely not under 654. That's just ridiculous. And if you do start getting down there, you're going to start getting a really big squeeze. But tomorrow, these people won't be there. They don't care. So that 654, 655, like if we pull up September 26, 2025 right now, yeah, I mean, I mean, look at 650 for tomorrow. They don't want it under 650 tomorrow, for sure. You're already up to 78,000 today. Now, again, we'll see what's open tomorrow at open interest. We'll see if it's 35,000 or 100 or whatever it is. But just using the information that we have now, they don't want it under 650. Let's look at the call side on it. Oh, look how many calls are at 650. Not many, right? So 650 will be a defending point tomorrow if they can get a long squeeze and bring us down. No, for me, the answer is no. I would only do that on a bounce back up today. So like if you get a little bit higher and you wanted to buy a put for tomorrow, be like, I think we'll be able to do that. But my here, I'm going to take partial in this again. My idea here is what I think's going to happen is I think they're going to hold this level. Um, we have 2 hours left to go. We have a lot of bears pushing, and they could create a consolidation period here that rolls us back over and gives us the extra legs needed. So something like this being done right here. And if they break that down, then yes, it's more likely with 650. So if you think that that's going to happen, the time to take shots would be as we push into the, let me find the exact level. So against 650 to 657. That's when you would want to take that short for tomorrow. All right, again, so 140 to now this is at basically 215, 215. All right, I got some off at 219 here. But again, it's very important that you understand what I put in at 1256. Because 1256 is telling you the inventory and what to do. So, what are the extremes? Extremes, according to what I said, was extremes would be 60 or below 55. What does that mean? Extremes. That means you're getting a long squeeze and or a short squeeze, and you're going above and below actually where the market makers want to have it. Like they don't want it up there. They don't want it down. They want to be able to slowly walk this thing down, make money, and blah 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 blah, but not get trapped. Now, if we look at this same exact chart at 3:30 or 3:15 in an hour, and all of a sudden you've got a bunch of different numbers, and there's 300,000 calls at 6:55. That could change everything. So you can only this is what makes trading so hard and telling you guys, hey, this is my stop, this is what I'm doing. The chart changes, and sometimes you can't have a computer do it because the chart's changing and you need to adjust on the fly as you see the information coming across the board. So now that we've got this balance, just think about it from CC. Do you have? You probably get sick of me doing this. Can you post the 1 minute chart on the SPY with those standard deviations? Because this was coming again. I don't have these on here, but this was coming down to that. You're probably you're within a little area of that second standard deviation. You're not quite far enough yet. If it would have pulled like quickly all the way to 654, it'd have been pretty close to touching it. I think we'll see. But if CC, if you could post that in here, that'd be great. If you can hear me. But anyway, the point of that is we're our mathematical, odds. We took the asymmetrical play from just the mathematical standpoint. Now that it's bounced back up into this area, this is the next rejection point. So, what are they going to do? Are they going to keep it around that 657, 658? Or are they going to create a new balance around 656? Let me see this. So that green one is that the second standard? Is that what that is? And then the purple one's the third standard. So do you see how like 654 would have been like the super extreme, right? Like if we would have gone down 654. That's like I forgot what it was. 99% of the time, it's not going to go lower than that. So that green line is, well, what, 95 or something like that, or was it 70? Anyway, as it goes lower, you get it's a lot more likely to bounce. And so again, if you look at the call volume for today, like check this out on okay, we're getting to extremes. Let's bounce it. Buy it for 130, 40, sell it for, I'm gonna take another piece off here, guys. Bam. Now, here's the question. Why did I do 654s? If I would have done 656s, you're up over 100% right now, right? You made 50, 60 cents, and you're up over 100%. So why did I choose the 654s? Yeah, it's at the money, but the point that I really want you to get is because I was willing to buy right here from 655 down to 654 area because that's if you start getting less than 654, this is going to turn into one of those times where it's the 1% time that it actually just chews through, and I don't want to be a part of that because that could turn really ugly really quickly. So if we buy a 656 at 655 and then buy a 656 at 654 and it just kind of goes sideways for a little bit, it's gonna get eaten up. I could go sideways and go down to 654, then add again at 654 and go sideways for a little bit and not get hit nearly as much as a 656. Does that make sense? That's why this is so important to understand. Like, yeah, you understand now that this is where you bounce. Now, how do you execute the bounce? And what are you willing to do and risk? No, you weren't here to remind me to record. Why would I be recording? But we just nailed this balance and talked about the inventory imbalance and talked about how I told you when this was trading at 1 p.m. where the extreme was, which means that's where you should try the bounce and or the short. And now we just made $1 million and you missed it all. Good job, bud. No, I'm recording it. Somebody reminded me. But again, these are the things that you need to do every day. You need to get what I'm saying, get what I'm typing out. Nobody put in chat like they're supposed to that I bought. I forgot. I said it on voice, so I didn't type it in. But this play, like in my mind, I told you guys what to do at 1 o'clock. Like the extremes are 55 and 60. If we get to those levels, you short it and or buy it. Like that's in my mind, I'm telling you exactly what to do. Then when it's happening and it comes down to 655, and I'm like, I'm willing to buy here, but then if it hits 654, that's the real spot where, okay, that's 654. If you wanted to buy 100, then you'd buy like 30 at 655 and then 70 at six, get bigger as you get to the higher win rate chances. There's a 1% chance that we go lower than 654. So yeah, I'll take a 99% win rate. So actionable items for the foreseeable future in our meetings that we have, right? Next time I say something like that, you will be able to identify it as an opportunity to make money, correct? What am I missing that I need to say to you guys to make you identify this as an area to make money next time? I'm just here. Okay. Okay. Now you know, right? Okay. So and explain it back to me. Why? Why are you buying and selling at those levels? Yeah. Yeah. Exactly. And so what it means is, and this is what makes it so hard. If what if 650 uh what if 655 was hit at 330 and it did this? Would that still be an extreme? Is that still a buy? Is that still a golden nugget? Anybody? Anybody? Bueller? What do you think? Yep. No, no, no. Like it did not hit down here yet. This chart hasn't happened, right? So none of this in this box has happened. But instead, we slowly grind it down like this. That's correct. And what does that translate into, though? That allows the people to adjust their inventory. And so you're going to have automatically more calls and puts around the levels as it starts going down. So as we slowly start going down to 657, you're going to have a lot more puts and calls around that area. And then 656, a lot more around those. So you're going to get a lot more transactions around those areas that lets people balance their inventory on the way down. So there's no extreme readings that make you have those extreme levels. Like the extremes would be 60 or 55 because of what I posted at the time, the picture. The picture's going to change at 3:30 if we're going slow. You're going to have a lot more people that are, instead of it being 375,000 on the put side at 368, I mean at 655, it and 68 on the call, it's going to be closer to, like, 370 and 150 or 200. It's just going to be a lot closer. And so if you look at 650, what was that balance at that time? If you look at 658 on the picture that I showed you, and we were to look at just right above and right below it, well, ultimately you can see, yeah, there's some imbalance, but it's not near like it was at 655 when this picture was taken. So going from the balance being 250 and 244, and then a below that price at 657, your balance goes to 264 to 120, 135. Yeah, it's a little imbalanced, but if you sit there for a little while, you're going to get a lot more calls to kind of balance it out. Okay. And then you do it again, it's going to be the same thing. And so as you go lower, people are going to be buying calls lower, and it doesn't make the inventory as imbalanced. And so, what our job is in every given situation as day traders and as swing traders is to find these imbalances and figure out the direction that we're going and partake in them. And that's what I mean by taking it from zone to zone. I'm going to get out of these guys. So again, very simple. Oh, I got filled on. I had some AAPs I got filled on as well. I'm starting to buy Novembers on AAP. If this breaks down, I'll stop out of those. It's more of a chart play than one of my long term picks, even though it's a long term pick. Yeah, that chart is ugly. And what's funny is I'm in it. I still love it. I love that it's doing this. Love it. What's the strike? Yeah, the Januaries are fine. The Decembers maybe. What? Yeah, yeah. You're what you again. What you have to be able to do is you have to be able to play the chart independent upon what you're holding. So a lot of times it's like, all right, finally we're starting to get a bounce on Amazon, wherever that comes. Let's say it comes at 205. At that point, it's like, oh, okay, well, let me add to my 245s or my December 245s. Yeah, you're gonna literally get a bounce from that 205 back to 220, but your options are only going to go up a small percentage because of how far away they are. And so it's like, all right, well, shoot, do I want to keep the 245s? Maybe, but if I want to add to this, am I going to buy the 245s? If I'm not, then why not just sell them? That's how I view it. If I'm going to add to them still, that means they're still in play. And so your 225s, it's like, heck yeah. Oh yeah. You got January and 225s? Yeah, let it go down 5, 6, 7 points. That's fine. We can still add to those and it'll still react pretty well. Yeah. So yeah, the time actually works against you because you don't want to cut them. Yeah. Um, and here's the hard part. There's no correct answer for you. What it comes down to is what you want to do and the original plan that you set up. So, for example, if I buy an out of the money, let's say I bought a 245 when it was at 220, and I think that this is going to be a bounce area. That's why I'm buying it further out of the money. And then it doesn't bounce, I have to cut it because I was buying it out of the money to do it. However, if I'm buying a 245 and I'm like, you know, great, I'll buy it again at 215. There's nothing wrong with that because you're right, you are out till December. But you can never go ahead and say, "Hey, I'm going to buy a 245" and not have a plan about when you're going to cut it because you've always got the time, and then it eventually runs to zero because of price versus time. Because what happens is you finally get your bounce at 205, it bounces to 220, and there's a 15-point bounce there that you could have caught, but you didn't catch it because your delta's so low when you should have shifted to the 220, so you could have caught a higher delta to play it. So the way that I do it again is if I'm willing to continually add to it, like if it's one of the plays that I would buy at that particular point in time, I keep it. If it's not, I get rid of it. I'm going to start a new one. So the question is here: so you get more for your dollars if you get a better delta. Well, it depends on how you define getting more. Um, the overall profit is higher. The overall profit percentage is lower. So here, I'll give you an example. I took these calls from a buck 40 to $3, right? So, uh, what is that? A buck 60 that I got out of it. So, what percentage is that? But then if you were to go and look at the 656s for today, you took them from, it would have been about 50, 55 cents to a buck 40 to 50. So maybe a dollar. 95 cents is probably what you would have gotten. So which one did you get more of your money for? In my opinion, it was the ones I get more money for the higher delta because I get a bigger overall. I got $1.60 versus a dollar, right? So the overall profit was bigger. However, your percentage return was much higher on the 656s, almost 200% versus a little over 100% on my end. Does that make sense? That's why, and again, I don't mean this negative towards Nate. Nate has to do this, but that's why Nate wants the 100% winners. Is it easier to sell a service if you have a 100%, 200%, 300% winner, or to say, hey, I bought an option at $10 and took it to 15, where your 20-cent option went to a dollar and you made 500% versus the $5 that you made. See what I'm saying? So it just depends on your goals and what you want to do. Yeah, so it's the same thing in the long term case. Like it's going to be the same thing if you're buying a 245 Amazon, you'll get a higher percentage return if it works versus the 220, but you'll get less money overall, less dollar win per win. Like the 245 you may get take $3 out of, but the 225s you'll take $10 out of. That's right. If it goes against you, you lose more, right? Yep. And so and again, that's why it's so hard to teach people how to trade because there's certain times where it's like this is a go time and let's really go at it. And then there's sometimes where it's like, hey, I'm going to take a lot of. So like on CLPT the other day, it's like, yeah, I could have bought 15s in the money and made a lot more money, but it's just not a chart that you're going to do that on. It's like, all right, I'm willing to throw away all this money that I'm taking a shot at CLPT and get lottos for 40 cents. And a perfect example here is the SPY. I thought we were going to bounce here. We may bounce tomorrow. Why didn't I get tomorrow's? Why didn't I get next week's? Why didn't I get next year's? Ultimately, I think in a year's time, we're going to be up from this point by 10 to 12%. Why not just buy some right now? You see what I'm saying? So it's always depending upon what you're playing, how you're playing, and what you're playing for. Okay, any questions about inventory? We'll call this inventory number 2 follow up. You know what might be a good idea before I cut it? So again, when I say I play inventory versus technical analysis, what did they do here from the technical analysis standpoint, guys? They undercut the low. See that? Technical analysis says we need to go fill this gap. Like it needs to come down here. We can't. For us to achieve that, my gosh, it's going to have to be a 1% thing, and it's going to have to be a super long squeeze. Play inventory. So now let's look at the updated inventory and compare it to what it was. Yeah, look how much 653 652 went up on the put side. A lot of people were buying puts in the hole. So a lot of people that again, this is newbie like behavior. They don't short up here, but they start shorting here. Okay, great. Um, on the call side, it's really not that much. So if this comes up to 658, 659 area, you've basically trapped all these guys, but I think it would come back down. I honestly don't think it's going to get over this here. We could, but to do that, you're gonna have to have trapped these people. But we'll see. Yeah, 658 still that balance point. You can see 657 is growing, 656 is growing on the call side, but not at the pace the puts are. And the puts on the 654, 653, 652 area, 650 are growing at a much faster pace than the calls. So what does that mean? Well, everybody's shorting, right? Everybody's buying puts, buying puts, buying puts. So the path to cause the most pain at this point is up. If we can shake all those people, get them to close their positions, that will allow us to roll back over. How would we do that? Well, again, break these key levels, give a false signal, and then just bring it back down. How do you know it's a false signal? You don't until it rolls. Okay, I'm gonna cut it.